Hey everybody, Matt Gruhn here with the MRAA. Hey, listen, we've got another great dealer conversation here lined up for you. Yours truly forgot while I was filming, while we were recording the session, to mention that we actually have some downloads for you. So we've got a great conversation today on some economic indicators that you are going to want to check out and pay attention to over the course of the next few months and into 2023. If you would like access to those documents, the slides that we're going to be showing here, you can click the link below either beforehand and follow along as we go, or download them afterwards and check them out for yourself. And for our friends north of the border in Canada, we actually have economic indicators for the Canadian market as well. So check them out, follow along. Hope you enjoy this conversation. Thank you. Hello, everybody, and welcome to another episode of MRAA's Dealer Conversations. My name is Matt Gruhn. I'm the president of the Marine Retailers Association, and I appreciate you joining us today. Want to set the stage a little bit for our conversation. We are now into the back half of 2022, the calendar year. It's the start of the 2023 model year. The marketplace is beginning to shift a little bit, and we're seeing that out there, and we're hearing that a lot from a lot of our dealers and so forth. We're seeing there's not as many pre-sold boats, not as many boats on order, market conditions, of course, with the inflation and the interest rates, fuel prices, which, you know, they've come back a little bit, but they're still out there and they're still an issue. New boat sales are beginning to slow a little bit. Inventory is starting to build back up. We're not quite back to where maybe we were pre-pandemic, but, you know, things are changing a little bit. And we are now into this phase of the post-pandemic marketplace, and we need to be prepared for that. So this marketplace comes with a host of new questions, or maybe not new questions, but older questions, maybe from a pre-pandemic time frame. The questions like, how should we be managing our business? What's the right amount of inventory? What are the economic indicators that we want to be watching and we should be watching? And many, many other questions. So you can see a lot of the chatter around this in MRAA's monthly pulse report. And I'm going to share with you real quickly here what you can find. But this June 22 edition that we've just published a few weeks ago asks dealers to talk about their outlook for the second half of the year. And it's a very interesting read. I would highly recommend that you take a look at this. Let me just share with you and show you where you can find it. If you go here to mraa.com/resources, you can find that pretty easily. What you want to do then is you want to go over here to this data tab, go into that. It'll take you into a report. You can see there's pulse reports dating all the way back to 2013, actually. But this most recent one here, if you click on this data report, it'll pull open the pulse report. You can go through here and you can look at things like who took the survey, dealer sentiment that we're measuring out there. This is a really good indicator for what's going on. Retail trends, how they're performing out there, different factors that are weighing into those retail trends. One of the most interesting here is you can see during the pandemic, we had these super low inventory levels that are now starting to creep back up. And it's a good place to kind of track that and see that. But then there's all kinds of conversation and comments about what's working, what's not working, how their first half performed, and what their second half outlook is. And you can see all of the different comments here on what's going on out there, what dealers are expecting, and so forth. So super valuable tool here that you can tap into, you can take a look at. They're free for our members. So feel free to dive into that, download those, take a look, and learn for yourself. In the meantime, we have a great conversation lined up for today and some really solid insights, particularly on the question that I mentioned about, you know, what economic indicators should we be watching and keeping an eye on as we're managing our business. So I want to welcome to this episode Mr. John Augustine. John, welcome. John is the Chief Investment Officer for Huntington Bank. So John, real quickly, a couple little introductory questions for you here. In the marine industry, we have been familiar with TCF Inventory Finance, and now TCF and Huntington are one and the same. So right. take a little bit of take a minute or two here and explain what's the relationship there.
So TCF and Huntington did merge. As you all know, Huntington located or co-located our headquarters to Detroit, Michigan for a commercial group. As a result, TCF Inventory Finance is very national. We're very glad to be associated with it. We'll continue to support that group. We know they're gonna be under that name for a while, but we'll show you a slide of Huntington here in a minute, what Huntington looks like. And we think Huntington can bring more scale to TCF while maintaining customer service. Huntington's all about keeping decision makers local. We think that's going to continue to happen, Matt.
Awesome. Great. Thank you. Well, appreciate that overview and that background. Tell us a little bit about your background personally, how you landed here in the marine industry.
Yeah, I've been doing this for 30 years. So I came in the investment business 30 years ago, and I've been serving as an economic strategist, an equity strategist, a fund manager. Now I'm a chief investment officer. So I'm greatly enthused about what I do. This is a 24/7 job, and I'm honored to be able to do it. Health and wealth kind of go together in a lot of people's lives. And it's been very interesting, got to tell you, since 2008. I think I was 6'4", Matt, when I came in this business, and now I'm down to 5'8". But it's gone well. Very glad to be here. I'm a boater. I'm a Lake Cumberland, Kentucky boater. Been that way for 15 years. So very glad to be here today.
Yeah, awesome. And if I remember correctly, you bought your boats from a couple of our MRA members.
Right in Cincinnati, Ohio.
Yeah.
Right.
Awesome. Well, I think, let's just jump into what we were planning to talk about today, with the economy. And it sounds, obviously, with your background, we got the right guy here to talk about it. You and I spoke a few weeks ago. We set this interview for today because we knew that between the time that original conversation took place and today, that we were going to learn a lot about what's going on in the economy through the first half of the year. We knew that we were going to see earnings from organizations like Polaris and MarineMax and Marine Products Corp and Brunswick and so forth. Give us a little bit of insight. What did we learn from those reports?
Yeah, I mean, in the public arena, all those stocks are down this year. So unfortunately, we're in a year where in general, stocks are lower and actually bond yields are higher. So we first off, we have to realize that. Second off, our equity team follows probably Brunswick the most. Brunswick's the broadest company. Brunswick's one of the larger companies. They came out and they said, everybody's guarded. Everybody's a little bit guarded right now. That's the best way we can describe the environment. They passed all the revenue and earnings tests, but everybody now is looking towards the future. We'll tell you why we're looking towards the future in a minute. But those companies, we would say, the boating industry companies, the suppliers, let's say, they passed their tests. Their stocks were all up in July. As a result, good month for investors in the month of July. We needed it after the first half of the year. But everybody's guarded, Matt. Everybody's kind of echoing the things you just talked about in some of the reports you went through with the group.
Right. So guarded, largely because of, the R word, the recession word, right? And everybody's kind of talking about that. Had a dealer tell me the other day, we got to be careful not to talk ourselves into a recession. But in the meantime, we see more reports coming, of course, from OneWater and Malibu and Mastercraft and so forth. But last week also had the other big news on interest rates, on GDP and so forth. And tell us a little bit about what we learned there.
What we learned there was technically the U.S. economy was in recession first half of this year. What's that mean? 2 consecutive quarters of negative real GDP growth. Real means before inflation. Now, when you hear the word GDP, think of revenue of a country. Okay, the U.S. has revenue of $24 trillion a year, by far the biggest on the planet. A recession means that revenue goes down for 6 months in a row. So think of it in those terms. Think of your business. So think of it in those terms. So, okay, technically we were in a recession first half of this year. Now there's a group called NBER that sets recessions, that will basically grade it to determine if they say fit their definition of a recession. So there's going to be a huge amount of debate. Were we in recession first half of the year or not? based upon NBER, National Bureau of Economic Research, and what they say. That'll come out in months, coming months, I should say. We don't think we're going to be in recession the second half of this year. There were some extenuating circumstances about the first half of this year. Primarily, government stimulus stopped. This rhymes a lot with 2001. For those of you that were in this business in 2001, we had a lot of stimulus come in the economy for Y2K, then it evaporated. So we ended up in a mild recession in 2001. We think that's what we're going through right now. What we're worried about is not the second half of this year per se, it's next year. That's what our economic team's focused on. We'll give you some reference points around that. Okay. So that's number one. We're going through earnings season right now, and it's okay. It's okay.
Yeah.
Now we're going through the Fed. And Matt, as you said, they met last week. They raised their benchmark interest rate. They do not meet again till September 21st. So there's going to be a great deal of debate. What are they going to do on September 21st? So the Fed is going to stay front and center economic debate rest of this year. It's just the way it's going to be. We'll point out why in a minute. But those were the things we picked up last week. Economy, okay. Recession, that's in the past. Earnings, they're doing okay. Fed, that's a question mark.
Right. Interesting. So yeah, you mentioned, those who were in the business in 01 and kind of the resemblance here. As we're looking ahead in this debate over are we in a recession, are we not, when will it really hit, and so on and so forth. It seems like the Great Recession of 08, 09, 2010, which of course was devastating for our industry, is still what people think of when they hear the word recession, right? It's still this deep, cutting downturn. What do you feel is different this time around? You alluded to it a little bit, but what's different this time around from what we experienced that time?
Balance sheets, both individual balance sheets and corporate balance sheets are in much better shape. We had a recession that at that time, we saw house prices and stock prices both go down together. That hadn't happened since the Depression in the 1930s. We think balance sheets are in much better place. Housing is not no doc loans. There's much more stringency around financing now. The members know that, just with respect to most any loan now. So we don't see this as a repeat of 08, 09. As we get talking about the economy a little bit more, it rhymes a lot now to us, our economic team, with 2001. What we're worried about is a double dip recession next year. That's kind of going to be the Fed's call. We haven't seen one of those since the early 1980s. I came in this business in 1989, so I was not in this business at that time. But that's what we're starting to think about for next year. We're starting to point our business customers, think about next year a little bit more, not second half of this year, next year.
Right. Interesting. And so now, as all of this stuff is happening, the volatility in the stock market is pretty crazy. The things that are causing it to jump up and down and so forth. We had the highs in January, we had the lows in June, we had a great month of July. August is off to a little bit of a mixed start. What's your take on how all of this is happening with the stock market and where things are headed with that?
Well, we came into this year, our theme coming into this year at our shop was normalization. We'd never been through a great lockdown. We'd never been through a great reopening. Normalizing this year, that was the theme. You get interest rates up a little bit. You get economic activity to slow a little bit. We knew the Fed was going to be in that mix. Then two things happened that we did not expect. We did not expect Russian invasion of Ukraine. And Russia is more or less a commodity superstore. So it's created chaos in commodity markets. That's the energy prices, big energy prices for our business. Then the second thing that happened this year that we did not anticipate was China continuing to be locked down around the virus.
Right.
When the rest of the world's opened up. And China is where a lot of supply chains start. So all businesses are missing some part because most of those supply chains start in China. So we still have disruption to supply chains. So Russia, China, Those are the two things that we didn't see this year. And Matt, to your comment, that's a lot of the reason why we're seeing so much volatility, not only in stock markets, but in bond markets and now in commodity markets, because commodity prices are starting to come down now. So everybody has a view of that, whether you're a producer or a consumer. So actually the volatility is picking up in commodity markets now as the global economy kind of slows down.
Wow, and there's a lot of that going on. One of the, you've talked about this a little time and referenced this a few times here, but one of the biggest things we wanted to chat about today is those economic indicators. And,
sure.
And as dealers start to think about how to manage their business going forward, answer some of these questions that I mentioned earlier, they need to start thinking about where's the market going and how can I kind of predict how it's going to impact my business. You've put some slides together for us today to walk us through some of that. Feel free to go ahead and we can share your screen there, and then you can just kind of walk us through them and explain to us what dealers ought to be looking at.
Thanks. Let's pull that up for the group.
There we go.
All right. So what we did was, Matt, after you and I chatted, I went to our economic team and I said, I'm going to talk to a group of marine dealers. Tell me the 5 things you're watching and give me a historical view of them that we can relate to this group that they can watch too, because there's a plethora of economic information. This is the 5, Matt, that they came back with. Now, what we're watching is broader, but these are areas of focus for us right now, okay?
Perfect.
So first off, let me go backwards in time a little bit. This is what Huntington's retail footprint looks like. Now, our TCF inventory finance division, our division, is basically national, but this green is what our retail footprint looks like. So the organization, one of the reasons I like Huntington, it was actually started by a person in Columbus, Ohio in 1866. It's never changed its name in the history of the company. I've always appreciated that.
Right.
Can't quantify it as how many banks are like that, but I've always appreciated that.
Right.
So the group now is associated with a $179 billion bank with a larger retail footprint, but we're national. Now, my charge is assets under management. So we obviously work with our clients on both sides of their balance sheet. My charge is on the asset side of our client's balance sheet, 26 billion. And we're organized just like you'd see any investment shop. As mentioned, an economic team, we have an equity team, fixed income strategy, etc. So we're very fortunate to have that. So just wanted to point this out, Matt, to the group first, if that's okay.
Perfect. Thank you.
Now, here's the 5 things we're watching. Number 1 is the Fed. And the number here to watch is 3%. What we're going to show you now is 5 charts that go back varying periods of time. This one goes back to 1993, as you can see here. The blue line here is the Fed funds rate. Fed funds rate is important, price of money. At the short end of the curve, it impacts our rates, our customer rates for financing. Now, here's what's important about the Fed. In May, they said, okay, we're going to take the Fed funds rate up to 2.75%. Markets were okay with that. Then in June and again in July, they came out and said, we're going to take it higher. We're going to take it to 3.75. We think that's too high. The last cycle, they stopped around 3%. We think it's dangerous for them to go over 3%. It's dangerous to the economy. So this 3% level, Matt, is what we're going to be watching first. As mentioned, the next Fed meeting, September 21st. Right now, they're in a range of 2.25% to 2.5%. So what we're going to watch now is moving into next year, will they go above 3%? And
so
all of us will watch that.
Yeah. So as they get above 3%, what are the first things that start to happen? What are the negative outcomes of that?
Well, in the last round, when they did a tightening cycle from 2004 into 2006, what broke? The housing market.
Right. We
We don't know what's going to happen this time because balance sheets are in much different place, regulatory environments in much different place. But generally, when interest rates are raised, you start to find some weakness in the economic system. That's probably, Matt, still to be determined We don't want to be in the middle of it
Right.
in our boating industry.
Right.
Now that's number one, the Fed. Right or wrong, they're going to determine probably whether we go in a double dip recession next year or not. So we want to keep an eye on them. They have 3 more meetings this year. The second thing we're watching, and we each have a view of this, is financing rates. Up at the top, look at that green line. How much does it cost my customer to finance? Well, interest rates, guess what they're gathering around now? 3%, doing the same thing today. So this is what's called a yield curve here in the US. This is lending your money to the government for 3 months out to 30 years. So you can see the varying rates here as of a few days ago. So we may each have a view of this depending on how long our customers have a tendency to finance. So we wanted to show this whole curve to you, because it's again, this 3% line is kind of the demarcation line. When these yields go above 3%, bond market's worried about inflation. When they go below 3%, bond market's worried about recession. Guess what? Right now it's mixed. Right now it's mixed.
Right.
So this is the second thing we're watching. Again, watch the 3% level. That number is going to be important.
Yeah. Great.
The third thing we're watching, we can't watch all of our customers' order books. On a national basis, what we watch is something called ISM indexes. Basically, they're surveys of purchasing managers saying, hey, how's business look 6 to 12 months out? What you want to watch here is numbers above 50. It's called a diffusion index, but that's not important to this conversation. When those numbers are above 50, that means growth. When they're below 50, recession. Now you can see this is a pretty good indicator in this chart going back 20 years, or excuse me, going back 30 years. You can see the long blue columns. Those are recessions. You see the Great Recession in there. When these two lines start to go below 50, that's when you get concerned. I want to recheck my order book and my inventory, Matt, you were talking about earlier. They're not below 50 yet. We got an update on this ISM manufacturing number this week. It's staying above 50. Later this week, we're going to get an update on ISM services. So this is something we watch for order books on a national basis, Matt. You talked about it with all the dealers. This is the best one we can get on a national basis. So this is the third.
Sorry, this is got to be a little bit of a reflection of supply chain issues, right? I mean, they're not able to stock up and drive the inventory levels that they want because of those supply chain issues.
Yep, supply chain is involved in this.
Yeah.
It's called dealer delivery times. There's a couple of questions they ask these purchasing managers from this. It is called Institute of Supply Management, is what ISM stands for. So yes, there are still supply chain issues in most every business that we're aware of. Yes, you're right. We just want this overall index to stay above 50 because it has a pretty good history of demonstrating when things are going to slow down quick.
Right. Okay, great.
Fourth thing we're watching. Now we're going all the way back now to weekly initial unemployment claims because we need employed people. We know there's some differentiation going on with respect to, let's say, salary levels. Lower salaries are getting hit by inflation more than higher salaries right now. We're probably seeing that in our customer traffic. This is literally a report that comes out every Thursday morning at 8:30 Eastern time. Weekly initial unemployment claims. This is kind of the beginning of what the unemployment rate will eventually look like. That's why we're looking at this, our economic team. Now, here's some numbers for you. We want to give you reference points because we're trying to answer the question in the green up at the top about what's going to happen to my customer base and people coming in my showroom.
Right.
So you see some green arrows here and a black arrow. Let's start with the black arrow on the right. Last week, weekly initial jobless claims was 256,000. That's pretty good.
Yeah.
Now look at the black box. If we go back to this history, going back to 1992, and we stop it right before the lockdown, the average weekly was 342,000. So we're still below that, but that's a number we want to watch now. Coming into the lockdown a couple years ago on February 28th, it was at 190,000. This number got down to 166,000. One of the reasons we don't see a real deep recession if we get one next year is because we're all still looking for workers. We can't find enough workers. Most any business, and really public or private, says the same thing right now. But we want to watch this because things are starting to shift a little bit. These weekly unemployment claims are going up, 256,000. The next number we want to watch, Matt, is this 342,000. All of our dealers can watch this Thursday morning, 8:30 Eastern, every Thursday.
Perfect.
The fifth item we're watching, this is a lot of information on this, but we thought you might find it of interest. These are leading economic indexes. There are actually two of them our economic team watches. The one in red it's monthly, comes from a group called the Conference Board. In the black box there on the left-hand side, we actually put the 10 items, the 10 data components that make up that index. We also watch on the blue line a weekly leading economic index. It actually comes from the New York Federal Reserve. There are 12 different Federal Reserve districts. This one comes from New York. There are 9 different components at that. They're listed in the black box at the middle. Just thought you might like to know that. These are okay for now. The blue line there is coming back down to kind of where it was from 2011 into the Great Lockdown. So that tells me whatever inventory, whatever sales level I was doing, that's probably what at that time from 2011 into 2020, that's probably what I should expect. But we watch this every week. Same thing with the monthly, obviously not every week, but we watch it every month. It's started to roll over. It's not in danger territory. But these are obviously trying to tell us what's the economy going to look like 6 to 12 months from now. So our economic team's paying attention. These come out, literally the weekly one comes out obviously every week, monthly one every month. You can watch these. You can go to yahoo.com and watch them. So kind of to summarize this for you and hopefully be of some help, that's what we're here for. Real GDP growth, yeah, it was negative first half of the year, probably won't be second half of the year. A lot of the first half of the year had to do with government stimulus programs rolling off. Now what's of interest is, will the Fed force a double dip recession next year? We don't know the answer to that yet. We don't think they do either, but we're going to be watching this data. We all watch different things. Matt, you talked about some of the things our members are talking about and looking at, excuse me.
Yeah.
Number 2 there, this 3% number. Later on this year, will the Fed go above 3%? Don't know yet. They probably don't know yet either. But it's something we're going to be watching. If we see your dealers later this year, we'll be talking about this.
Right.
Number 3, it's really a supply constrained world. We all know that. That's what the boat and motor maker and engine makers were talking about in their earnings reports. Everybody's missing some part that probably originates, I should say, from China. So we're and we can't find enough workers. So we are still in a supply constrained world. Demand is holding up. We know there's some socioeconomic effects on demand with inflation. Lower scale slowing down, higher scales staying in there, higher net worth, let's say. But demand seems to be generally holding up in a supply constrained world. Central banks can only deal with demand. They can't deal with supply constraints. So there's a little bit of a mismatch there that worries us. Number 4, it's about order books. We can't get into everybody's, so we follow a national one. And it's still saying things are going to be okay 6 to 12 months from now, but we watch it every month. Number 5, Matt, that has to do with the other side of kind of our business, our investor focus right now. We're focused on these 5 areas. For investors, probably the most recent one in play was patience, because as you said, markets turned around and went up in July.
Right.
So being patient worked out for investors in July. This is for, though, our dealers, and up at the top at the green, be proactive.
Right.
Be proactive around that order book. There's not a lot we can do about commodities. Obviously, we all watch the price of gasoline because it affects our customers. But be proactive around your order book. Extend it into next year. Matt, you talked about it earlier in the conversation.
Yeah.
So
that was the thing. That's okay.
That's okay.
Sorry, that was the thing that caught my eye there, is the businesses be proactive. You know, one of the big things that we're talking about around here at MRAA, as we're talking with our dealers, things that we're talking about at Dealer Week this year is building the discipline in their businesses and getting back to the fundamentals of running a good business. What are some of the things, when you say businesses should be proactive, what are some of the things that they should be thinking about? What does that mean for them and how they apply it to their dealerships?
Well, kind of three areas. So obviously, number one is best you can, and each business does this differently. Your order book, right? How much traffic am I seeing? How many orders am I getting? The second thing is employees. Suppose things do slow down. How many employees do I need? So right sizing my employees. And unfortunately, for a lot of businesses, we can't do it very much here. They're going to machines because they can't find people. Now, we can't do a lot of that, but that's what a lot of businesses are talking about. Now, the third thing we're talking about with businesses, again, I apologize, it's a little bit different. It had to do with commodity prices. For most of this year, we saw lower commodity prices in the future than now. So what we were saying to this goes back to the Brunswicks, et cetera. Use your purchasing managers to help your bottom line via the futures market. So in other words, the cash markets right now were very expensive for a lot of commodities. Futures markets were cheaper. So there's ways your buyers can help the bottom line. But for our business, we need employed people. The confidence numbers you talked about earlier, there's two of them in the States. The reason we didn't put them in this package or this deck, they've split. Consumer confidence has remained high.
Right.
Consumer sentiment coming from the University of Michigan's at a 40-year low or 50-year low.
Right.
But they've been split since 2016. Something happened in 2016. Don't know what it is.
Right.
So we're not sure which one to watch yet. So that's why they weren't in this deck, but that's a different discussion. So
yeah,
there's all kinds of things we're watching. We hope these five help out, because members can watch these on their own. And that's what our team put together for us.
Yeah, the disconnect between consumer confidence and consumer sentiment, something that we've been looking at. I'm just curious how that has happened. But historically, when we look at the business of dealers and we talk to them about what they're watching and what's impacting their business, the consumer confidence is certainly a leading thing that they've historically talked about. A lot of dealers talk about housing in the housing market, whether it's pricing or starts or whatever it might be. Some even look at the RV industry, right? There's this belief that we're, somewhere around the 6 to 8 months behind the RV industry, whether it's an up cycle or down cycle. How do those factor into this? How do they play a role in what dealers should be looking at?
You talked about confidence. We don't know which one's right. Is it confidence or sentiment? We don't know. We hope it's confidence because it's a much higher number. And now there's a long lag generally when confidence starts to impact spending. And it's generally different industry by industry. So just keep that in mind. Okay, confidence is getting hit by all kinds of headlines, from political to geopolitical headlines right now. So be careful of that a little bit.
Right.
Now, house prices, we would equate a little bit to our industry. So our take is at Huntington is there is a shortage of homes in the country.
Right.
In a lot of the boating segments, there's still shortages of supply. You talked about it yourself, in inventory.
Yeah.
So there are still shortages, basically, and we all know what's going on in the auto industry too, missing semiconductors.
Yeah.
So there's actually supply constraints going on in housing. We would also say that's going on in the boat market. Okay. So, and then RVs, that's a little bit tougher demographic comparison, but I see the connection there. But that's a little bit tougher demographic.
Yeah.
Connection. Our business is generally younger.
Okay.
So just to give you some thoughts there.
Yeah, no, it makes sense. One of the things that I think is most critical in this whole conversation as we look at these indicators is, from an economic standpoint, there's a lot of talk about, hey, creating or manufacturing this soft landing with the economy, raising interest rates, but not driving us into this double dip recession and so forth. in a lot of ways, that analogy can be transferred over to the marine industry with our inventory levels. We've been through the last 2 years where we've had little to no inventory. It might be fair to say that we've gotten away from the fundamentals of managing our inventory levels properly since they were a little bit too high in 2019. And now we're in this scenario where supply is getting better, demand is dropping a little bit, and we could be, and we're a ways away from this yet, but I think looking out longer term is appropriate, but we could be getting into this cycle where we may over inventory our dealers, right? We may build too much and they end up carrying too much product and putting themselves in a financial situation. How do you think is the best way to go about managing that and talking about that balance between resupplying the dealers, getting them the inventory levels they want and need, but not going too far with it?
Well, a couple things. So first off, we're going through a transition in our business from IOs to outboards too, right? So we're going through a couple different things at the same time. Now, the housing market measures in its inventory in month supply. The auto industry measures its inventory levels in days supply. Now, we probably fit in somewhere between those two. Now, when we talk to you next, we can go back and construct what those levels were in various periods in history. 2007 comes to mind, and you talked about 2019. Then kind of maybe that would help our members kind of get a gauge on where they might want theirs to be, depending on a slowing economy. That's what this is about. We grew 5.7% last year in the US economy. We're probably going to grow between 2 and 3% this year. That's what we normally do. That's what we normally do in the US. Will we be on the low side of it? Probably. Do we worry about next year? Yes. We want to stay in the 2 to 3% range economically. Then we can help you link housing inventory and auto inventory to that kind of growth. Maybe that would help our members in the future.
Yeah, I think that'd be great. That'd be very interesting to talk about and look at. So you noted this in a couple of the bullets that you talked about where dealers can find this, but is there a place where you would recommend dealers go and look at for how they monitor these indicators on a regular basis? I know we can go into the weekly report and the monthly report, and then there's the weekly report on unemployment and that sort of thing. But is there a place where dealers could turn to look at this stuff fairly easily, or do they have to kind of go out and construct it on their own?
Well, I hate to say it, given my age, but apps, there's economic apps out there now that give you all this information. I have one on my phone, or I use Bloomberg for a lot of that material. So there are apps or sites that'll give it to you. I hate to say at my age, I'm following apps, but I am. So there are places that will consolidate the information you can pick up easily.
Excellent. All right, we'll take a look at that and get some info out on that. What else? Is there anything else you feel like we didn't cover today that we should be talking to dealers about?
High end is still buying. Low end is getting hit by inflation. So we hope inflation comes down. Energy prices are going to have a lot to do with that. The Fed thinks they want to slow demand and take the unemployment rate up. We hope they don't take it up as much as expected, because that's our customer base.
Right.
So literally, we're watching employment. We know balance sheets are in good shape. We know people and businesses are probably over cashed. So we think demand is still going to be out there, because we're still in a supply constrained business, we would say, along with housing and autos. And so that should bode well for us. The inventory levels, you got to match it to who's coming in the door now. Do you have to shift it to more higher end customers, or can you stay with lower end fishing, center consoles, pontoons that were so hot? So our industry is evolving too, just like autos. So we have to pay attention to that too.
Right. Excellent. Wow. Well, this has been super insightful for me. I've got a ton of notes here that I've taken. So I really appreciate you lending your expertise to this conversation and give us some thoughts to take with us into the last half of the year. As you and I talked about, and make sure our members know this, but we're going to be talking about a lot of this type of thing at Dealer Week this year, and how dealers can really adjust their business to the post-pandemic marketplace. December 5th through the 8th in Austin, Texas. I know you're going to be there with us, and looking forward to seeing you down there. But it's definitely an opportunity for our dealers to really start to, as you said, get proactive with their business, to start to reinstall the fundamentals and the basics of their business and the foundation and so forth, so that they can be prepared for whatever 2023 brings, whether it's a
Yep.
double dip or otherwise. So really appreciate your time today. Thanks for everything with this conversation. And we look forward to seeing you in Texas.
Matt, thanks.
You
Thanks.
bet.
Hope it was helpful to the group. Have a
Absolutely.
great rest of your day.
All right. Thanks. You too.